So right here on Public Exposure, we are very fortunate to be working on the foreclosure crisis. And this working on is trying to understand it and trying to see what you're going to do individually. We're very fortunate to have with us Howard Bono, who is from the Financial Revival Group. The website is myfinancialrevival.com. Strongly encourage you to go to the website because you're going to learn an awful lot. And you don't even have to tell anybody, do you, Howard?
Nope. You can go anonymously.
So in this segment, we're going to talk about the inside story on loan modifications, and we're also going to bring the IRS in here, oh boy. But let's talk about what is the inside story on loan modifications. It seems to me to be an obviously appropriate thing for banks to do.
Well, the loan modification falls under you'll hear the acronym HAMP, Housing Affordable Modification Program. And the basic idea behind the HAMP program is if people are in a situation where they can't really afford their house, what if we, the banks, modified their loan so that the payments dropped? You know, would people be more inclined to continue to pay? That's the biggest concern the banks have, is getting people to continue to pay. The problem that they have with the HAMP program is you might think that the banks, when they're dealing with this, are very organized. They are absolutely, it's insane how disorganized they really are. The last statistic that I read was that less than 4% of the people that actually apply for a loan modification actually get one. Here's the worst part.
Less than 4%?
Less than 4%. Here's the worst part. When you call and say, hey, look, if I can get my house payment lowered a few $100s a month, I'm good. And the first thing the banks will tell you is that unless you're 2 or 3 months behind on your house payments, we can't help you. So what they're telling you is we're choosing not to help you. That's not a requirement, you know, but that's something that they've put in, and it's universal. You have to be 2 or 3 months behind on your payments before you can even talk to the bank about doing a loan modification. The next thing that you have to do after you get behind on your house payments is you have to send them all of your financial information. So how crazy is that? You know, you're a basketball coach, right? So it's like walking across, 2 minutes left in the game, walking across the court and asking the opposing coach, what play should I run next? And he says, until you're 20 points down, right? And also I want your playbook. You know, you get 20 points down and I want your playbook, and then I'll tell you. And that's exactly what the banks are doing in this situation. They're putting people in a default situation. 3 months behind on your house payments, the foreclosure process can start. So they're putting you behind the 8 ball there, and then they want your playbook as in addition to that. So, and they're only approving 4%, less than 4%, of the loan modifications that people ask for.
I don't understand this. On the Financial Revival, my Financial Revival website, there's a statement here and a quote from J.P. Morgan Chase. It says, "We are not in the loan modification business." Well, I thought they made money off of interest.
Well, they make money off of interest, but the truth is, if people get behind in their payments, that was a statement, by the way, from the CEO, Jamie Dimon. You know, and he basically said, loan modifications are a difficult process for the bank. It's very complicated. It's very drawn out. They do get money from the federal government. The federal government set aside, I want to say it was $75 billion to give to the banks for doing these loan modifications. So the banks then are going to take less money in interest every month from these individual people. But in order to do that, they have to go through all of this. It's almost like doing a new loan for people all over again. But they're also...
But isn't that their business?
Well, it is. No, their business is to have you sign a document and make regular monthly payments to them. And they're borrowing that money at a lower interest rate. They're lending it to you at a higher interest rate. And they make money on the arbitrage, the difference between those two. That's their business. If they're not getting the monthly payments, their arbitrage goes away. And so what they're concerned about is people that are just saying, I'm not going to play anymore. And so that's where the loan modification came in. This was the federal government's way of saying, we can fix the housing market without really damaging the banks and without really doing anything for the homeowners. And they put this program together that was supposed to help 3 to 4 million people, and so far it's helped less than 500,000.
Yeah, and it's not working.
It's been a dreadful failure.
So for those people who say that they're not going to play anymore, those are the people who are just taking their ball and going home. They're taking their money and leaving.
Yes.
What's a short sale?
A short sale is a situation where, let's say, going back to the Mark and Sarah example that we used, Mark and Sarah's house is worth $180,000, they owe $270,000, or in that range. Could they sell their house in today's market for 180? Maybe, maybe not. People are looking for deals. That's the only thing that are buying. If they could sell that house for 180, they can't sell it and be complete with the bank. So what they do is they sell that house for 180, and the bank agrees that they will allow Mark and Sarah to be short on the payoff. So that's where the short sale comes in. So you can sell your house even though you're upside down in it, but you have to have the permission of the bank in order to make that happen.
I see.
So
we only have about a minute left. So I got to ask this question. The IRS is coming in and taxing people in short sale situations?
Short sales and foreclosures.
I can't even ask the question. I mean, it's so backwards.
It is, and here's why. So let's say that Mark and Sarah sell their house for 170. The bank loses $100,000 on that transaction. Mm-hmm. The IRS says that if the bank loses money on that transaction, that $100,000, for example, the IRS looks at that as a gift. So JP Morgan Chase gave you a gift of $100,000 because they accepted $100,000 less as a short sale. So typically the bank the IRS wants taxes on the $100,000. However, there is a law that's good through the end of 2012, started in the Bush administration, extended in the Obama administration, that says if it's the first loan on your house, the primary loan, and it's the house that you live in, and the house is foreclosed prior to the end of 2012, that you don't have to pay that.
Well, with that, we're going to make that be the last word. If you want to learn more about everything, all of your financial opportunities, let's put it that way, go to myfinancialrevival.com. We'll see you next time right here on Public Exposure. Take care.